The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Can the Mag 7 be magnificent again? We're an hour away from finding out. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. Here is the setup as we count down to that big earnings calendar at the end of the trading day. You see the S&P 500 pretty much unchanged right now, giving back earlier gains. Same story, a little bit more dramatic when you look at the NASDAQ 100, now down about 0.2%. We get Alphabet, Tesla, IBM, Texas Instruments, and ServiceNow all in the 4 o'clock hour. Meanwhile, take a look at what's going on with Brent, higher by about 3.6% right now, trading with a $94 handle, sending yields higher once again. The 10-year Treasury yield currently higher by about 3 basis points, Romaine.
Yeah, that is the setup to the countdown to the close, and the countdown, of course, to those big tech earnings. So you mentioned the names there, and we should point out that Texas Instruments, well, that's the only stock in that group to post any meaningful gains over the past 3 months as investors wake up to the analog chip makers' role in the AI race. But for the rest of today's lot, investors do need to see that the billions of dollars sunk into being AI champions is indeed paying off. Now, last reporting season, Alphabet and its Google Cloud business, it did emerge as the strongest proof of concept for actually monetizing the AI boom. The division posting year-over-year revenue growth of 63%, at least double any other division. And operating income there, it actually tripled. But sequential quarter-to-quarter growth rates could show softness and would call into question any boost to guidance for spending $190 billion on capital expenditures this year and $260 billion next year. As Jordan Jackson put it, times have changed, and if you're not raising earnings forecasts in step with raising Capex, your stock just might get punished.
We're penciling in over $1 trillion worth of hyperscaler Capex spend next year. That's up from expected about $760 billion for this year. And again, to your point, it's really eating into profitability. For the second quarter alone, we're expecting about 95% of earnings to go towards Capex. And by the end of the year, the company's spending more on Capex than they are earning in profits.
So expect some volatility in the shares today. Now, the implied one-day move for Alphabet is only about 5%, but in 5 of the past 8 earnings, the stock actually did churn more than what the options market had actually telegraphed. The implied moves for Texas Instruments and ServiceNow, those stand at about 9% and 12%, respectively, Katie.
Let's dig in a little bit to the momentum trade, because that's where a lot of your AI and your semiconductor names live right now. We're taking a look at the UBS momentum basket. Actually, after this recent sell-off, posting its best one-day gain since about August 2022. That has the UBS trading desk say now might be the time to start rebuilding some of your positionings. That, this drawdown that we've seen in the momentum factor has really cleaned up positioning overall. So, we'll see if what we get after the bell today sort of signals that now is the time to maybe buy that dip.
Absolutely. Well, let's kick things off to the close with Steve Sosnick, Chief Strategist over at Interactive Brokers. All right, Steve, what's the data telling us? I feel like the last few earnings season when it comes to big tech, we're coming in expecting volatility. This seems a little bit different, right? It's not just about whether you can post some phenomenal revenue growth. People really do want to see what the margins look like and, of course, what profitability overall looks like.
I think that's correct, Romaine, because what's going on now is, I've been saying all along, it's a necessary condition if you want to rally after earnings to beat on your revenues and your published EPS guidance. Mm-hmm. But it's no longer a sufficient condition. You have to do something extra. You have to either say that your guidance is in line with estimates, but beyond that, or some other great story that your margins are increasing, or you're finding some great productivity benefit from your AI spending or your AI usage.
And I singled out Alphabet. They're probably, the best of everyone in the basket in terms of at least what they've shown so far. But when it comes to everyone else, there are still a lot of questions, particularly once you get past kind of the gigantic Mag 7 names, which I think most people feel are still relatively durable. But once you get beyond that, do you have confidence, or have you seen enough confidence among traders that some of those names will also show some sort of proof of concept?
What I think we're getting into here is the bar being set so high that it becomes very hard for some of these companies to deliver. We've seen this a lot recently, where you've had companies say good things. The latest today was GE Vernova, where they're saying everything they need to say, and the market sells off anyway. Tells me one of two things is happening, or both. Number one is that the bar again is they could say whatever they want, but the whisper, I hate that term, but the whisper number is set too high. Or number two, everybody who wants to own the stock already owns the stock, so there's no great catalyst to get people into it in a bigger way. To me, the biggest story that I'm listening for this afternoon is, does Sundar Pichai say that they are going to continue to spend the $190 or $260 billion that they're saying, and are they getting their money's worth? If he doesn't, or if Satya Nadella says something different next week, beware, because there's a whole lot of investment riding on the fact that these companies are just going to continue to plow money out the door and into semiconductors and the like.
Yeah, absolutely. The idea that, these handful of big giant names are going to sort of bankroll the rest of the AI trade. So keeping an eye out for that. I do want to talk a little bit about Tesla, because there's sort of the opposite dynamic going on at Tesla. They've spent just $2.5 billion of the $25 billion in 2026 Capex that they had forecast in April. When you take a look at the options market, when you take a look around positioning around that name, what does it tell you?
Tesla today, when I looked at the numbers this morning, was surprisingly normal, dare I say. Tesla's really not that, like the probability distribution was like almost a perfect normal distribution spread around like the at-money options. The implied volatilities were, a little higher than you might expect, but not terribly so, sort of around 5% on an average daily basis. None of that, it was really shockingly normal. The skews had that sort of normal, Elvis smile, the sort of asymmetric, skew profile that you get a little bit extra to the downside, but, a little more to the upside as well with sort of the low being around the at-money options. I was shocked at how normal it is. And what's interesting to me is Tesla was always the number one or number two most active stock on our platform, without fail. Lately, it's dropped out, sort of out of the top 10 even some days, because SpaceX has taken all the luster. So I think the Musk faithful have moved on to some extent.
Yeah, it's going to be fascinating to see how that develops, that Elon Musk premium, whether it can extend to two publicly listed giant companies, and maybe the early data suggesting maybe not here. We are about a week out from, actually exactly a week out from the next Federal Reserve meeting, and we did just learn that Kevin Warsh is going to hold a press conference. I am. I've been watching fondly from the sidelines. But in any case, Steve, it's not quite a live meeting, maybe not as live as it was, but there are a lot of question marks around where this Federal Reserve goes. How do you think that that's working its way into the market, if at all, or is this just really a micro story?
I don't think it is, because I think we're still feeling out the new Fed chair. We don't really know what we've got here, right? I mean, the market was pricing in, greater than 50% chance of a hike at this meeting, and that's all but dissipated, and that's fine. Personally speaking, I think he's sort of inclined to wait until after the election, because I think that, he does not want to be seen as putting his thumb on the scale in one direction or another. But in terms of where's he going, is he going to be this single mandate Fed chair that the market sort of that the market sort of got the first impressions of, or is he going to have to focus on labor again? We still need to know what he's going to say and what he's going to do, and maybe he bought himself some time to sort of do nothing by having the various 5 committees. But I think it's important. The market needs to know what the Fed chair thinks and what he intends to do. So yes, Katie, it's important.
See, there you have it, Katie.
There you go.
Who told you it wasn't important? Steve, always great to have you. Steve Sosnick there, Chief Strategist over at Interactive Brokers. Some breaking news we want to bring to the attention of our viewers. Shares of Chipotle, Yum Brands, Sweetgreen, Cava, all taking a leg lower here. This after we're learning that the FDA, the Food and Drug Administration here in the U.S., is adding new cyclospora cases to the number of cases that have actually been determined. This is an alert about a new outbreak of cyclospora, Katie. And you kind of brought this to my attention, I think, a week or two ago when we were kind of first sort of wondering what was going on. The FDA alert says it has not yet identified the product linked to this latest event, but there's been a lot of talk, of course, about what we saw with the last outbreak and how it's being addressed.
Yeah, absolutely. You saw that initial knee-jerk reaction when this first came on the scene. Then a little bit of a relief when it seemed like the FDA had identified the source of the problem. You can see sort of the shock working its way through some of these food names now as the FDA actually comes out and says that they have not yet identified a product. We will continue to follow that story. This is The Close.
Times, well, they're really good for banks. At least that's what Wells Fargo CEO Charlie Scharf told me in an exclusive interview this morning, just about a week after the bank's earnings results. The fourth largest bank in the country, it's now back to growth after almost 7 years of regulatory constraints. Now, Scharf says the bank is ready to grow. Here's more from that conversation.
What you've seen since the asset cap has come off is that we're able to compete on a level playing field with everyone, and we're growing our consumer bank, we're growing our commercial bank, we're growing the wealth business, we're growing our core investment bank, and we're doing it in a way which very, very highly focused on sustainable growth and higher returns. And we think we got huge opportunity in front of us.
When you say sustainable growth, some investors want to see aggressive growth.
Yeah.
Can you be aggressive and be disciplined and sustainable?
I think, listen, in this business, you got to be very, very careful about what aggressive means. And we also have to be very, very careful about distinguishing between what the markets are adding to our performance or any other financial services provider's performance and what we're doing. We're not looking for quick wins. We're not looking to take outsized risks in the short term to drive stronger results. We're looking at building the underlying franchise, building customer relationships, building flow of things that will go up and down based upon how the markets are doing. But that's what I mean when I say sustainable over a period of time.
Well, talk about this transition then, because over the past few years, I mean, people will look at what you've done over the last few years and call that a turnaround story. Although we should point out, Wells was in relatively good shape even when that asset cap was placed back in 2018. Was that a turnaround story, or was that just kind of regulatory rehab?
Well, I wouldn't call it. I think you're right. It's not a turnaround story. The company was always very strong. We always had a great franchise, but we had to fix things that needed to get fixed inside the company. But from our customer standpoint, we were serving them every day. We were making loans. We were taking deposits. We were constrained on growth, but we were there providing what we did day in and day out. And financially, we were still doing okay. And when we looked at what we were able to deliver, we're not able to grow our balance sheet. We've been focused a lot on efficiency inside the company. We've been focused a lot on growing our fees inside the business. So our corporate investment bank has grown very nicely. Our credit card business and credit card spend is growing very, very nicely. Focused on building treasury services, and now we can grow the balance sheet so we can more holistically serve customers. And that's what you see when you look at the results of this past quarter, with earnings per share up 25%, revenue growth double digits, growth across every one of our businesses in terms of revenue. We're certainly in a different place. And our goal is to be viewed as the best financial services provider in these businesses in the country. How
much of that is because of Charlie Scharf and the executive team, and how much of that is because of market conditions and economic conditions? Well,
I think it's predominantly because of the quality of the franchise and the broad group of people that work at the company. Listen, what I and the new management team have been able to do is get people focused, create a different set of priorities, but a lot of people execute day in and day out. And the fact is, the markets do help. So there's no question that, I mean, these times are really good for banks. And so if you're not doing really well as a bank today, there's something not quite right with either how you're executing or what your strategy is. And that's not lost on us. But again, we look at the underlying metrics of each business. We're growing our consumer checking accounts. We're growing commercial banking customers. We're growing the kinds of loans that we want to grow. We're taking the risks that we want to take that we think will provide strong returns over cycles and not get over our skis and not pretend that it's all us. Some of it is the markets for sure.
You have a very keen insight into the economy across all the geographies here. When you look at sort of the rebound that we've seen post-pandemic, whether it's in New York or even some of the down south and some of those markets here, I mean, what are you actually hearing from your clients, the people that you're talking to, about where they're doing business, and more importantly, are they comfortable right now being able to do business?
So I would say what you hear from them and what they're doing aren't the same things. People are nervous. They read the newspapers, they watch TV, they see what's going on in other parts of the world. They're concerned about AI. And so those are things that are very much on their mind. But when you look at what they're doing, when you look at consumers, they're spending more year over year. Their delinquencies are down. They're saving more. They're doing really, really well. When you talk to smaller companies across the country, again, they're nervous. They're concerned about how they should be planning for the future, but they're in really great financial condition.
As you sort of continue this growth story for Wells Fargo, do you feel like the economic conditions will be supportive as they have been over the last couple of years?
So I'd separate into what I know versus, what we would guess. What we know is that the strength continues. When we look at the stats day in and day out, the strength of the consumer, the strengths of businesses hasn't changed from what we reported just a couple of weeks ago. Are we nervous about what the future holds? Sure. The fact is things are really, really good. Markets are really strong. Things are, there's certainly volatility, but things are priced quite well in the credit markets and in the equity markets. There's a huge amount of liquidity out there. There's a huge amount of financing take place. And at some point, then that doesn't go on forever. So we're trying to be very thoughtful about recognizing that good times don't last forever. But things don't look like they're breaking quite yet.
Is your expansion or the growth in this business going to be primarily in the U.S.? There's been talk that you may be looking to expand some of your investment banking business over in Europe.
So, but predominant, so we're 95% of our revenues come from the U.S. We're thrilled about that. So goes the U.S., so goes us, and we're big time bullish on the U.S. And so we're going to continue to invest in all of our business here in the U.S. And believe that there's significant opportunities for us to grow with the economy and to take share. The business that you mentioned, the investment bank, does have to grow outside the U.S. For us to serve large companies and middle market companies as they want to expand outside the U.S. properly, we need to have a presence. We need to have distribution capabilities. We need to have advisory capabilities. But it's there primarily to serve the customers that we do business with here in the U.S.
Whether you're there past 2031 or beyond, what exactly do you want to make sure gets done over the next 6 years?
I think we've got the opportunity not just to have Wells be a better performing company, but be back to what we should be, which is the best performing financial institution in this country, which means real sustainable growth with the highest returns adjusted for our business mix. And ultimately, that should drive us to be the most respected bank in this country. And we compete with great people out there, so it's not going to be easy to do, but that's our goal.
Charlie Scharf, the CEO of Wells Fargo, talking about the turnaround, if you will, if I may use that word, of the bank and his plans for how to continue growth going forward. Now, when we come back, we're going to go from one financial company to another, Blackstone. Their earnings due out tomorrow. We're going to break down what to expect when we come back here on The Close, right here on Bloomberg. Keeping an eye on capital markets stocks. Blackstone set to report earnings tomorrow before the bell. Analysts over at Goldman Sachs flagging a significant gap between Blackstone and its peer group and where its shares are trading and what he says are strong fundamentals for those names. Alex Blostein joins us right now, lead asset manager and capital markets analyst over at Goldman Sachs. That's a mouthful, Alex, but let's talk here about exactly where the stocks are going. Because, Blackstone, along with some of these other asset managers, have not performed well. I think they're down Blackstone's like 20% this year. But I was actually looking at just this fall from grace here, but then I was looking at the actual performance of some of these in terms of AUM, revenue, other things there. Why is there this disconnect right now between what we're seeing in the share performance and what we're actually seeing in terms of the fundamentals?
Well, thank you for having me back. So I would break it down to two sort of things. And you're exactly right. The alternative asset managers, for the most part, have massively lagged the rest of this kind of capital markets trade that we've seen so far this year. 90% of this underperformance is effectively multiple derating. There's been a little bit of negative earnings revisions, and most of that is related to monetization activity being a little bit slower in the first half of the year. We actually think it starts to reaccelerate in the back half. But most of it has been multiple related. So why is that, right? So the market is clearly debating sort of the terminal value growth for some of these companies. And that comes down to two sort of big areas. One is wealth. It's been a really important part of the market. That has seen slower growth in the first part of the year. There's been a lot of concerns around non-traded BDCs, private credit. We can hit on that as well.
Yeah.
So that's been one issue. Kind of, is the growth sustainable enough to warrant the multiple of these companies traded in the past? So it's the first issue.
Yeah.
And the second one is, like, at what point are we actually going to start to see some of these monetizations come back?
Right.
Yeah.
Which has obviously been slow. So that's been sort of the issue. Looking at tomorrow, look, I expect we'll hear a pretty bullish tone on wealth broadly. We've seen a steady recovery and a lot of the funds outside of private credit. I think there'll be a little bit of a better tone on monetization as well.
Right.
And things like private credit continue to hum along on the institutional side despite of all the concerns that have been out there.
Well, before we get to Blackstone tomorrow, let's talk about the news that we saw from them today, that they're finally launching these 2 new interval funds in partnership with Wellington and Vanguard. We know that these have been in the hopper for a while. Before you saw all the agita at the beginning of the year with retail in private credit. And, I wonder what you make of this, both of, the fund structure that they're going with interval funds and whether or not that retail investor is really there to even be interested.
Yeah, so the one big thing I think it underscores is that the space as a whole is not pulling back from retail in the wealth channel, and it's still going to be an important part of the growth driver. So we think roughly 20% of the growth algorithm, kind of management fee growth for these businesses, will come from wealth for the next couple of years. To your point, like, these products are obviously new to the market. This is a blended version of sort of private investments with public, both active and passive within a single wrapper. I think they're a bit complicated. I mean, I think if you look at what happened with KKR and Capital so far, it's taken a really long time to ramp, and the flows there continue to be relatively muted. So where we've seen more recent growth has been much more in these pure plays, whether it's kind of standalone private equity, standalone infrastructure, standalone secondaries, up until recently credit. But these kind of pure play private so far has done better. But I think we'll see more of this. I mean, I think the wrappers in which alts will engage with the wealth market will continue to expand.
What do the margins look like on a product like that relative to the standalone stuff?
Yeah, so the fee rates are still going to be pretty healthy for the alts players. If you look at the standalone, it's north of 100 basis point management fees. Obviously, there's performance fees on top of that. So, which is again one of the reasons why the market is so focused on this, because there's a lot of economics in these revenue streams for these businesses.
All right, Alex, unfortunately, we are up against the clock. We have to have you back very soon. Previewing, of course, Blackstone earnings, shares down about 19% on a total return basis. That was Alex Blostein. He is lead asset manager and capital markets analyst over at Goldman Sachs. Now, coming up, Stifel out with earnings as we get a fuller picture of how the financials are faring. We're going to speak to the CEO next. This is The Close on Bloomberg. All right, keeping an eye on shares of Stifel higher today on the heels of a second quarter earnings report this morning. The bank raking in $1.45 billion in net revenues, marking its best second quarter in its history. Joining us live, I'm pleased to say, is Stifel Chairman and CEO Ron Kruszewski. Ron, great to have you with us. So really beating across the board when it comes to your net revenue, whether we're looking at investment banking, asset management, or wealth management. But let's focus in on wealth management, since that is by far your biggest revenue generator at this point. What led to the beat, and what do you see sort of continuing that momentum?
Well, first of all, wealth is the durable part of our model, and it has been for years. Our institutional businesses, we've had more operating leverage in that. But turning back to your question, wealth, we've continued to gain market share. We won J.D. Power, employee advisor satisfaction. That's voted by the advisors, made us #1 for 4 years in a row. And so we'll grow through recruiting. But importantly, we're going to see a lot of productivity gains from AI. I mean, it's the topic not only of the day, but of the year. And we see the ability to just do a lot more business in the same sort of container. We have a great business model, and I see it continuing.
And when it comes to AI, I want to talk about that a little bit in the context of advisor recruiting, because you said on the earnings call today that advisor recruiting remains as competitive as I've ever seen. And I wonder how much, you're competing against AI. I feel like you and I have had this conversation before, but it's just getting ingrained in the muscle memory, especially of the younger generations, that, you fire up an LLM for advice, and I would imagine increasingly that extends to financial advice as well.
Well, we'll see. I think that there's sort of a disconnect, Katie, because every time something comes out about an LLM doing something, all the wealth stocks, including ours, get hit. Yet, every wealth firm in the country is recruiting at the highest level ever experienced advisors. So which is it? Is it that the LLMs are going to replace advisors, or are advisors important? I'm on the side that the advisors are the last mile of advice, and that as AI gives you more abundant information, but as you get more abundant information, the value of advice goes higher. So that's where I land on that. We'll see. But there was a recent survey that said from 2009 to 2023 or 24, I think it's by Bloomberg, frankly, that the affluent people that would use advice was 30%. Now it's up to 60. So I'm in the advice game.
Yeah, and that was by Bloomberg. Thanks for shouting us out, Ron. We always appreciate that. Yeah, glad.
Hey,
I am curious about just a couple of interesting things that jumped out at me, particularly with this earnings. Obviously, we knew the IB business was going to do great. Wealth was doing great. I was taking a look at fund banking, and I know this came up on the conference call. There was very strong growth there, and I was kind of doing the calculation. Something like about a quarter of your funded loan portfolio right now is fund banking. And I am curious, is this sort of a longer-term growth opportunity for you, or are you just kind of taking advantage of what's been happening in the moment with regards to what's going on behind the scenes in private capital?
Well, look, I would like to think we never try to do anything in the moment, Romaine. We just, we always have a strategy. I would like to tell you that, and it is true. We got into when SVB and all that happened, we recruited a lot of people. We went from maybe 3 people to probably nearly 200 now in venture lending and fund banking, and we view it as an integral part of that ecosystem. Not only can we lend to companies, we are helping the sponsors and the venture funds, and we're providing wealth management to the founders, and we're doing investment banking. So it's a great growth opportunity for us, and I'm excited about it. And I think you noted the trends, and I would expect those to continue.
Are there any concerns here about private market valuations and them maybe potentially being out of sync with what we're seeing with regards to public valuations?
Well, we've seen that for a while. I mean, look at just when I'm asked about acquisitions, and I've done probably as many acquisitions as anyone in my career, at least in building Stifel. And today, I'm being shown deals that, let's say 15 times adjusted EBITDA, and I'm trading at 8. So there's a disconnect right there, which tells you, by the way, why I'm buying my stock instead of doing acquisitions.
I also want to talk a little bit about investment banking, beating when it comes to revenue there versus estimates. We know that Stifel was one of really a plethora of banks that were involved in the SpaceX IPO in some capacity. Really curious what that process was like, and moving forward now that that's in the rear view, how you can sort of build on that.
Well, look, that was a well-managed process. I hate complimenting my larger firm competitors, but that was a well-run process. For us, though, it didn't really drive our results. It did drive the results, I think, of the larger firms. But we were certainly involved. We expect to be involved in the other ones. But for us, what you saw was the breadth of our platform, and it was not. Both people think, Stifel's depository M&A. No, that was actually somewhat muted for us relative to healthcare, technology, and industrials. And so we have a pretty broad-based, diversified platform, and you saw that come through. Investment banking was up over 40%.
Ron, are you planning to do any more acquisitions anytime soon? Anything you want to tell us?
Hey, I'm always evaluating things, but as I said, I think the private valuations, especially with leveraged returns, has made those things. I'm a little cautious. So we're not just going to do, Romaine, a deal for deal's sake. I'm not looking just to do a print. I'm not looking just for revenue. We had 24% return on tangible equity for the quarter and for the year, and frankly last year. That's my measure, return on invested capital. And some of these deals require some Excel, growth assumptions to make them work that probably I'm just not comfortable with at this point. But hey, we'll see.
All right, Ron, we'll talk to you again soon. Really appreciate you taking time for us. That's Stifel Chairman and CEO Ron Kruszewski there, fresh off the company's earnings report. The shares up about 2% here in the cash trade as we head towards the closing bells, with a big focus on tech. And when we come back, we're going to focus on a big tech launch. Samsung launching a new line of foldable phones. We had a chance to sit down with the Senior Vice President of Mobile Product Management. Part of that conversation coming up next, right here on The Close, right here on Bloomberg.
Samsung unveiling 3 new models of foldable phones to its lineup today. The new phones coming ahead of any announcement from Apple on its long-rumored entry into the market. I sat down with Drew Blackard. He is Senior Vice President of Mobile Product Management over at Samsung to discuss that launch.
The all-new Z Fold 8 is joining the family, the way I like to think about it, because it is, to your point, our third foldable device. So before we had our Flip device, which is known to be more portable, where you can easily kind of fit it into pockets, simple, lightweight. And then our traditional Fold, which is more of book type, was more about productivity and multitasking. And what we found is over the past few years, there's just been an explosion in terms of mobile video consumption specifically. And so consumers are spending up to 80% of their screen time on their mobile device versus, say, large format devices. And so we wanted to make a new form factor that was really tailor-made towards consuming content and watching video. And so what we announced today was that new form factor. I have it here, which is our all-new Z Fold 8. And so you can see just, from this screen here, how it's really fits content perfectly. If you go into full screen, you get much slimmer black bars, things like that. And then, of course, these days, a lot of the content consumed on mobile is vertically oriented. So it's, the aspect ratio is perfect for social media, reels, and things like that.
It's interesting, the timing of this announcement. You're getting a jump start on Apple. The point has been made that your biggest competitor is a phone that actually doesn't exist yet. Apple coming to the market with their first foldable phone later this year. So you have a head start here. How do you plan to make the most of it?
Well, for us, this is our 8th generation. So this is a technology we've been refining and perfecting over the years. We really feel like last year was a big inflection point with our 7th generation, where for the first time we were able to get the form factor down to that of just a standard bar-type smartphone. Traditionally, in years before, consumers had felt there was maybe a trade-off. I could get the bigger screen and the foldable form factor, or I could have the more lightweight, portable bar-type form factor. But now we're able to get both into a single form factor. And I think on top of the refinements that we've made year over year over year, that's led to breakthroughs in durability and portability in terms of the actual weight of the devices. These are slimmer and lighter weight than we've ever had before. So those are things that we've really tried to drive into the technology. But in addition to that, we're providing choice. Again, this is 3 different form factors. So on one hand, you have that Ultra model, which will be our Fold 8 Ultra, for maximum productivity, things like multi-window and multitasking that's natural for. The one I just showed you, our Z Fold 8, will be really around content consumption and perfect for gaming and watching video. And then Flip is more of that portability form factor. So we really feel like we're leading the way in terms of the innovations that have driven us to this point. And then we're able to also offer consumers choice as to what form factor is going to fit their lifestyle best.
In April, though, you did raise the price of some configurations of the Z Fold 7. There's some speculation that, the prices that we're talking about today could soon conceivably go higher. And I wonder, how much you've sort of built that idea that price hikes maybe might be an inevitability here.
Yeah, I mean, it's a really unpredictable time. I've been in the mobile industry now over 20 years, and I can say firsthand it's kind of the most unpredictable moment we've had, and that includes COVID, when there was a lot of supply chain challenges. And so we're looking at that and forecasting out as best as we can to try to understand, how are we able to maintain a price point and not have a lot of kind of disruption that confuses consumers and things like that. So we even look at things of how we dial back promotional activity and trade-off balances. But what we've done here today, again, is try to do it in a way where we're packing as much innovation in, it's still an accessible price point for these products without big increases year over year.
And our thanks again to Drew Blackard. He is Senior Vice President of Mobile Product Management over at Samsung, with a little bit of a product demo there of their new foldable phones.
Yeah, it was fascinating. So you don't have one of these foldable phones
no,
yet, right?
You
still have the non-foldable ones.
Yeah,
right.
Keeps trying to die on me.
But you bring up a good point. I mean, the biggest competitor is basically the phone that hasn't been released yet, but that's going to change in a couple months or so. And I think is the idea that they're going to compete on price?
Yeah, I don't know. It seems like the prices just keep going higher.
Was there a price tag on that thing?
Yeah, about $1,900. So there you have it.
There you have it.
Coming up, it's Closing Bell. We're going to take you there with Mandy Zhu of Cboe. This is The Close.
Just about 10 minutes away from the closing bells here in New York. I'm Romaine Bostick.
And I'm Katie Greifeld. We're looking at a tepid close for the equity market. The S&P 500 going to finish just about unchanged. But we know that the real show begins in just a few minutes' time, Romaine. Of course, we get Alphabet, we get IBM, we get Tesla. The list goes on. And a little bit of a downdraft in both the S&P 500 and the NASDAQ 100 headed into that.
And we talk about the AI trade, the tech trade that has led to just record highs after record highs. That's cooled a lot. I mean, chip stocks have kind of oscillated. We've seen the hyperscalers pull back pretty significantly. I think a lot of people want to see some proof of life as to the return on investments. Alphabet going to be a big litmus test for that. I am curious to see kind of how Texas Instruments fits into it, because they've actually had a nice run over the last few months as people kind of woken up to how analog chip makers are also part of the AI race. And I don't know what to make of IBM, given that pre-announcement that we had.
Well, that's the thing. Really interested to see, if the numbers have changed at all versus what we saw last week for IBM. But it sort of fits into this broader conversation about return on investment. You've seen a lot of pull forward when it comes to some of the hardware components. But as we were discussing at the top of the show, if there's any hint that Alphabet and some of its peers maybe aren't as committed to those Capex plans, you have to imagine that it will just be mayhem.
Absolutely. We're going to get those earnings after the bell tonight. We will have full coverage as soon as they hit. But before we get there, let's bring in Mandy Zhu, Head of Derivatives Market Intelligence over at Cboe Global Markets, to talk about what we've been seeing in this market. A relatively lower volume day, at least when you look at the major indices. A lot of activity, though, in the options market. I was looking through on the Bloomberg terminal, too, the most active options, and pretty much everything for the top, 20 or 30 are all basically expiring today.
Yes.
I feel, correct if I'm wrong, but that feels like a bit of a shift. I feel like if you had looked at this chart, I don't know, a year ago or 2 years ago, it would have been a little bit more of a mix in terms of the expiry. So many people now seem to be doing these zero-day options, largely betting on whether it's a SPY or a triple Qs or whatever, and basically just kind of riding or dying based on whatever happens that particular day. Is this our new normal?
Yeah, so I would say the rise of zero DTE trading, it's been ongoing. So it started in 2022 when we listed basically Tuesday, Thursday expiries in SPX, completing the set of daily expiries. And then earlier this year, we now have Monday, Wednesdays added to single name. So on the back of that, you've seen really same-day, zero-day trading in single stocks kind of explode higher, similar to what we saw in SPX. Now, there's a little bit of misunderstanding in terms of what exactly is going on with the zero DTE trading. I would say particularly the index level, it's pretty mixed in terms of both user base, retail and institutional, but also use cases in terms of, obviously, a lot of people taking directional bets on where the market is going, but actually a significant portion of that is actually investors selling these options for income, so coming into the market on a systematic daily basis, generating income with these zero DTE options.
What effect does that actually have on the actual stock prices, index prices themselves? So
we've done actually a pretty comprehensive study looking at this, and the key takeaway is that because the flow is so balanced between buyers and sellers, the net impact onto the underlying index is actually de minimis. I think that is a source of one of the initial misunderstandings around this product. I think a lot of people assumed retail investors or investors in general were predominantly buyers of these options, or buying these options purely to speculate, and therefore market makers on the other side who were presumably short would have a lot of as a hedge would make outsized market impact. But we show kind of through the data that we see, which for SPX we capture 100% of the flow. We can show empirically that is not the case. It's pretty evenly split between buyers and sellers, and as a result, the market impact I think is pretty minimal.
And Mandy, we were having a conversation before the segment started about perpetual futures because they're often compared to zero DTE options in sort of the same breath. And as we start to see perps actually enter U.S. markets, certainly become a bigger part of the conversation, how do you anticipate that to change the complexion of markets, if at all?
That's a great question. So yeah, we've definitely gotten a lot of questions around kind of the parallels between perps and zero DTE. And there are some similarities, right? Like both products are very popular with retail, both products offer leverage, and both products have seen a lot of growth in recent years. But they're fundamentally, in our view, different products. So perps or give you leveraged exposure to a linear asset, or linear leverage exposure, so meaning it moves 1-for-1 versus the underlying. Options, on the other hand, give you convexity, meaning on the upside, if you get the direction right, you can make 5x, 10x, or even more relative to the underlying. And then, even just as importantly, on the downside, with perps, your downside is the same as your upside exposure, meaning that, with the same leverage, that can magnify gains on the upside, it can also magnify losses on the downside, whereas with options, kind of the core appeal of options to a lot of investors is ability to cap that downside risk. So when you buy an option, all you can lose is your premium paid. And as we're seeing in zero DTE option trading, even those who are selling options are doing it through spreads where they define the risk at the outset. So I think that's a really important distinction between these two products.
Something I wonder about with perps, and you touched on this a little bit, is the investor base, is the use case, because it seems like perps, they're more appealing to that retail investor right now. But I mean, could you see a case for institutional usage? What does that look like?
So I would say there are a lot of drawbacks in terms of really institutional use case. I think the core appeal of perps and why it's really kind of grown in popularity is the ability to give retail investors leverage exposure. In this case, it was to crypto. Are institutional investors struggling to find leverage or gain leverage to underlying assets? I don't think that's necessarily the case. If you think about use cases for perps, the primary, I would say, the dominant use case is speculation. That's why if you look at the volumes of perps, it tracks very closely to the performance of the underlying asset. So when Bitcoin prices fall, demand for perps fall. When Bitcoin prices rise, demand for perps rise. Whereas if you look on the option side, what we've shown kind of again and again is that option, this growth in option volume, whether you're looking at SPX, single stocks, that's secular, right? Yeah. People use options for a variety of purposes, hedging, speculation, for income. That's something you really can't get on the perp side.
Only about a minute left, but what are people using these options for when it comes to this earnings season, which is about to kick into high gear in a few minutes?
Yeah, interesting. So definitely a lot of positioning ahead of earnings. I think this earnings season, particularly for the AI names, the tech names, it's incredibly important. We're seeing it in terms of the level of volatility being priced into these names. If you look at single stock volatility, record high relative to index volatility. Some high-level takeaways, particularly around the retail positioning. We get a lot of questions on that. We've seen actually a pick up in bullish positioning around the hyperscalers in particular going into earnings season by retail. So buyers of call options have really picked up, when you're looking at Google, when you're looking at Microsoft. So I think the expectation certainly is high, and as you guys mentioned earlier, the implication in terms of their Capex spending certainly will have widespread ramification for the entire industry.
Mandy Zhu, head of derivatives market intelligence over at Cboe Global Markets. And speaking of those hyperscalers, the first one out of the gate in just a few minutes with earnings from Alphabet. We're also going to get earnings out of a few other companies, including IBM, Tesla, and Texas Instruments. Our full micro coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Taking a look at equity markets right now, Carol Massar, a bit of a holding pattern as everyone right now awaits for some big earnings out of big tech.
Yeah, it's a big report after the closing bell. And I'm thinking about Alphabet. We talked with our Mandeep Singh and trying to understand the AI spend, the Capex spend, what's going on. And he said that this is really a key report, what we get from Alphabet, what they have in terms of cloud spending, but what they are doing in particular. There's some really high estimates about Capex out on the street.
Yeah, the big question is, when is Capex spend going to slow down? Mandeep doesn't think it's going to be today, doesn't think it's necessarily going to be this quarter. And which company will be the first one to blink? He doesn't think it's going to be Alphabet. He doesn't think it's going to be Amazon. He thinks it's going to be Meta Platforms.
Interesting. Yeah, we know that Meta has certainly sort of been at the front of the pack when it comes to their Capex spend, and a lot of questions as to what they're actually spending it on versus, a more traditional hyperscaler such as an Alphabet. But we don't have too much longer to
Maybe the
wait.
Meta glasses.
Yeah, exactly. Those are costly, but it'll be interesting to see what happens, whether or not when we get through some of these big tech earnings, beginning with Alphabet, whether that starts to reset the tone for the Magnificent Seven, which we know has been lagging.
Yeah, for Alphabet, obviously, a lot of people want to see what that Google Cloud business has done in the most recent quarter. Expectations for 60+% growth. On Tesla, it's going to be a lot about those Auto GM X credits there, as well as, of course, everything going on with the Robotaxi and IBM, of course, with that pre-announcement just a while ago here. Be interesting to see whether they adjust anything further. Right across the screen on this Wednesday afternoon, the Dow Jones Industrial Average relatively unchanged on the day, down about 5 points. S&P 500 losing about 10 points or 0.1%. The Nasdaq Composite down about 0.6% on the day, and the Russell 2000 lower by about 0.9%.
All right, guys, as we await those big earnings, S&P 500 kind of an even split, 246 names to the downside, actually 246 to the upside, 257, Katie, to the downside.
A quick look at the sector level as well, nearly an even split, as even as you can get. 6 sectors in the green, led by utilities, higher by about 2.3%. Materials, energy, also having a good day. Then you take a look at the downside. Communication services falling by about 1.3%. You also had consumer discretionary as a sector fall about 0.8%, and that was followed by a bit of a decline when it comes to healthcare as well. That sector falling by about 0.6%.
All right, guys, we're waiting for earnings. Just now crossing Texas Instruments. Second quarter Capex, $514 million. That's light. $676.3 million was what the street was expecting. Second quarter EPS coming in better than forecast. $2.14 a share. Street estimate was $1.93 to the outlook. Third quarter EPS coming in light. $2.23 to $2.57. Actually, forgive me. That's a range, so we'll see what that compares to. Third quarter revenue, they're looking at $5.65 billion to $6.15 billion. Right now, the street remain, you can see it just down about 3.5% here, so some disappointment.
Yeah, kind of interesting to see where that Capex number came from at 514, and the street looking for 676 here, whether that is a one-off here, but the company is saying that it is sticking to its full-year Capex plan of $2 to $3 billion. So this does appear to maybe be just a one-quarter adjustment with regards to that. Alphabet earnings now crossing the wire. If we want to get to that, guys.
Yeah, let's do it.
Yeah, let's do it.
All right, you take a look at Alphabet right now, just parsing through some of these numbers. Second quarter revenue coming in at $119.8 billion. That is ahead of estimates for about $170 billion. Meanwhile, you take a look at the cloud revenue, which we know has been in focus. That is the red headline on the terminal, coming in at $24.77 billion for second quarter cloud revenue. You take a look how that compares to the estimate, slightly ahead of estimates of $22.46 billion. Shares rising a little bit here as we parse through some of these numbers, but a second quarter beat when it comes to Google Cloud revenue, a second quarter beat when it comes to EPS as well.
Yeah, overall revenue too at $119.8 billion. The estimate was for $117 billion. Second quarter revenue, excluding traffic acquisition costs, coming in above estimates, $103.62 billion. The estimate was for $101 billion. Search and other revenue coming in ever so slightly shy of estimates. We can go ahead and say that meets estimates. YouTube ads revenue did beat. That Google Cloud revenue, though, the important number that people are watching, that beat $24.77 billion. The estimate was for $22.46 billion. Second quarter Capex coming in at $44.92 billion. The estimate is $44.15 billion. In the after hour, shares bouncing around a little bit, but up about, well, now down just about 0.3%.
And I would argue search and ad revenue also key, because this, is a company, this is so important to their financial picture. And, whether or not we saw a big outperformance last quarter, going back to advertising revenue up 14% year over year, 81.63 billion. That is just slightly above the estimate on the street of 81.12. Going to search and other revenue up 17% year over year, 63.27. So, folks, that's pretty much what the street was expecting. I'm not surprised to see the stock just up about 0.8%. I'm wondering whether the street was looking for a little bit more here.
Well, it's kind of, but you're still talking about 80% growth at that Google Cloud business. And of course, you're talking about operating income for that unit more than a doubling. And it gets to this idea here as to are people still kind of looking at the expenditure numbers and wondering how that all balances out. Of course, there was also the big news with regards to the release of some of these new AI tools. And the company now talking about saying that its Gemini app now has 950 million monthly active users. Whether that's good or bad, I guess we'll have to defer to BI on that one.
Okay, well, while we wait for BI analysis there, let's talk a little bit about what's happening with Tesla. Second quarter adjusted earnings per share coming in below estimates at 33 cents. Shares of Tesla down by about 1.3%. Second quarter revenue coming in at $28.24 billion. That beat estimates by just about $2 billion. Second quarter negative free cash flow, $1.09 billion. The estimate was for negative $3.64 billion. Full self-driving penetration continued to grow in the quarter, the company says. The company also saying second quarter gross margin came in below estimates at 16.8%. The estimate for that was 19.4%. Once again, second quarter revenue coming in above estimates at $28.24 billion, beating estimates of $26.32 billion. Shares of Tesla down about 1.4%.
Yeah, and this was a company that needed some good news when you take a look at Tesla's year-to-date performance. I also want to point out when you break down their revenue number, revenue overall actually beat estimates, but energy generation and storage revenue coming in at $3.14 billion. That's actually a little bit light versus estimates of about $3.77 billion. We know that as Tesla, works through some of its traditional car company issues and headwinds that have weighed on the stock, that the energy and the battery business have sort of been a bright spot, but again, revenue in that specific segment a little bit light versus estimates.
Yeah, and just in terms of kind of, future businesses, Tesla expecting Optimus production in Fremont later on this year. We're talking about, different things like whether it's EV spending, autonomy, or robotics. These are all part and key to the Tesla future story. But I think that second quarter negative free cash flow of $1.09 billion, the estimate was for $3.64 billion. You're seeing the stock down about 3.5%. And then again, that second quarter adjusted EPS coming in pretty light. Again, that second quarter EPS, the company also more than doubled its Texas on-site computing during the first half, and giving us some more about the business. Semi and Mega Pack 3 remain on schedule for production. So getting a little bit more color in terms of the business, but investors don't seem that impressed. Stock right now down about 3%.
Yeah, before we go, I do want to go back to Alphabet and just take a look at that backlog on the Google Cloud business. You said you were talking a little bit earlier, Carol, with Mandeep Singh, and he was really kind of hammering home the point here that it's not only about the revenue growth in that business, but the backlog as well. That did increase to about $514 billion, up from roughly about $450 to $460 billion. But again, there's a lot of calculus going on right now as to sort of how that shakes out with the company's plans to spend as much as $190 billion this year on Capex, and as much as $262 billion next year, based on Bloomberg calculations. They don't really articulate that in any of the written statements that they have released, but I'm sure this will come up on the conference call in just about 30 minutes.
Yeah, we're going to have Mandy back in a moment, too, and I'm sure you guys are talking to him as well. But beforehand, he had said it needs to be worth, I think it was about $600 billion in terms of that backlog. So it's coming in at $514 billion. Still a big number, still impressive, but is it impressive enough? And we did see certainly shares of Alphabet under some pressure. All right, guys, good stuff. That is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals, breaking down some of those key earnings this season. Katie and Romaine continuing, of course, on the close on Bloomberg TV. Tim and I back here on Bloomberg Business Week Daily on Bloomberg Radio. Folks, we will see you again, same time, same place tomorrow.
And our earnings coverage continues here on Bloomberg Television. IBM crossing the wire right now. The company, which of course pre-guided just a few days ago, saying that revenue in the quarter $17.16 billion. Software revenue at $7.76 billion, which was actually a miss here. Free cash flow also a miss, $2.54 billion. And operating EPS in the quarter at $2.93 a share. For the full year, Katie Greifeld, IBM says full year revenue on a constant currency basis is going to be up 4 to 5%, and it had previously seen an increase of about 5%. And then that consulting revenue, which of course was part of the concern with regards to that pre-announcement, $5.33 billion. The estimate on the street was for about $5.39 billion.
Yeah, and that was the question coming out of that pre-announcement that we saw last week, whether we're going to see their overall full-year guidance maybe downgraded a little bit. Looks like we're seeing that. Shares not reacting too much, maybe higher by about 1%. But you think about the absolute wipeout that they saw last week. It's going to take a long time to dig out of that hole.
Yeah, we'll keep an eye on that. IBM shares oscillating between gains and losses. Alphabet, Tesla, Texas Instruments shares are still in the red here in the after-hours trade as this market tries to digest a slew of earnings coming out of some of the biggest tech names and, of course, more importantly, some of the biggest gainers over the past couple of years. Rich Weiss joins us right now here in Studio 2, Chief Investment Officer of Multi-Asset Strategies for American Century Investments. Rich, great to see you here.
Good to see you, Roman.
An earnings season where we knew expectations were going to be high, particularly given the run-up that a lot of these stocks have had. And I guess the question is, was there any way that any of these companies were actually going to impress investors?
Oh, going to surprise on the upside?
Yeah.
I'm about to surprise.
Yeah.
Maybe just meet, if not beat.
Yeah.
And I think that's what we're looking for. And let's face it, you look at the returns, I think the market expects that. The Magnificent Seven are actually lagging this year, right?
Yeah.
They're about flat net year to date, while tech in general is up some 15%, S&P's up 10 or so percent, small caps up 20. So I think the market is pricing them to just meet expectations going forward. They're fully valued. We're looking elsewhere.
Yeah, well, I'm glad you bring that up because, Bloomberg, they put out, sort of the expectations for earnings growth by sector and everything else. No surprise. Most of the growth still concentrated in the technology space. But when you kind of go down the ladder, not only in terms of sectors, but also in terms of market cap, there was actually some pretty healthy expectations there as well. And we've pointed out on this show several times that despite the run-up we've seen in the S&P, even in the NASDAQ, the Russell 2000, at least in aggregate, has actually kept pace. And I do wonder if that is indicative of this idea that there is a broader earnings story out there beyond the Mag 7, beyond chip stocks, beyond the hyperscalers.
No question, a broadening out of the market across sectors, across stock factors you brought up. It's not large growth factors that are winning this year. It's actually value and small cap, right? Which is a distinct sea change from the last 2 or 3 years. So, and across all industries, maybe not stellar earnings growth so far, but high single-digit, low double-digit growth across virtually all sectors, Xing out energy and tech. Yeah, of course.
So small caps outperforming, value outperforming. They take up very little mind share, though, very little part of the conversation. How do you get investors to care and sort of broaden their aperture? Because, I mean, at least using ETF flows as a proxy, it seems very hard to attract inflows into basically those parts of the market.
You're right. They're not part of the FOMO momentum trade, right? But as longer-term investors, they are part of a well-diversified portfolio. And who wants to put all their chits on a number on a roulette table? You want to diversify across. So small cap is a good area to do it, if not even something like bonds or other asset classes, healthcare, other industries that haven't been in the spotlight recently. They may be smart plays, not only because they haven't seen the momentum, because they're arguably undervalued.
Well, going back to big tech, I mean, you mentioned the stat that you think about the Mag 7. Not too impressive when you take a look at the performance year to date, sort of just bumping along. Your view, they're fully valued. It seems like the market is looking elsewhere. But, I mean, what could they deliver at this point? What could excite investors to the point where maybe you see those shares come back to life?
Oh, well, if we're thinking about Jensen Huang's 5-layer AI cake, that's a term familiar, I imagine, to your audience. So,
sounds delicious.
Yeah, it looks delicious. So the surprises could come in any one of those 5 layers. Maybe not, the models, which have gotten so much press, the Claudes and the co-pilots and such, or even the chip makers, but in the other layers, whether it's the space and energy or data centers, or most importantly, the applications at the top of the cake, the cream of the crop, which traverses many different industries. If we start to see that take off, which arguably it has not yet, at least not fully in the investment management business, maybe that's going to fuel a fire for more growth in these other AI stocks.
I do want to go back to the value side of this equation too, and the idea that we've seen value and other value type of factors outperform momentum and even some of the growth factors out there. Part of the argument I've heard from some folks on this program has been the idea that if you're going to evaluate AI, you have to look at it from the use case. The idea that the winners in this aren't always necessarily the people selling the chips, the hyperscalers building the data centers. It's going to be that finance company that finds efficiencies, or the biotech company that finds a better way to discover new drugs, et cetera. Is that something that is easy to suss out now? Or is that still kind of in the future where we have better clarity as to the companies that are utilizing AI for their own purposes and finding a benefit?
Right, that's the top layer of the cake, right? The applications across many different industries, very early in that cycle. Very difficult to suss out, as you say, Romain. But that's where all the action is. I think most active portfolio managers are looking to that space, trying to figure out how to position there smartly. Again, healthcare, legal industry, investment management industry. I mean, we all have FOBO at this point. It's a fear of becoming obsolete, okay? We'll see what happens there.
Absolutely. Rich, you are sticking with us, of course. We're joined by Rich Weiss of American Century Investments. I want to bring in Anurag Rana of Bloomberg Intelligence into this conversation. I want to revisit what's going on with shares of IBM right now, because they're actually a little bit higher after hours. They came out after pre-announcing those results last week, Anurag. They came out today cutting their full-year sales outlook, which was broadly expected. But when you take a look at this share reaction and what we learned today relative to what we heard last week, what do you make of it? Why do you think shares are higher right now?
So if you look at it, the revenue came in the second quarter about 1% or so. And what they're saying is for the full year, they are looking at 4 to 5%. So, you could expect some improvement. And one of the things we talked about even last time when they reported was some of the funding changes is because of people buying more hardware and servers at the expense of some of IBM's software. And one of that software units is the transaction processing segment, which was down 9%. Now, you buy this software in conjunction with the IBM mainframe that you bought, a few quarters ago. So what is most likely what we're going to hear on the call is that customers who have delayed those purchases will come back and buy it either in the third quarter or the fourth quarter. And I think that could be one reason why the stock is bouncing a little bit up.
There were two areas of concern. Obviously, the idea that some of these big customers were actually delaying or putting off their orders. But there's also this idea that some of the existing customers are basically trying to find, using their own AI tools and technology tools to find ways to replicate or, if not completely displace, their need for IBM, their need for ServiceNow, their need for Salesforce, et cetera. Is that a little bit overblown, Anurag, at least in terms of your own analysis and what you're hearing?
Yeah, well, at least for this quarter is massively overblown, because that's really not the case of the reason why they are missing. The shifting in funding or the IT funding is what's happening. Now, if they are able to replace IBM or other software packages 3 years from now, it's a completely different story, but that's not what's happening right now. We are merely seeing companies buying AI-related products, not AI-related products, but let's say servers and storage devices, which are going to go up in prices because of higher memory costs down the road at the expense of consulting and traditional software.
And another detail from this IBM report that is interesting is that the company is saying it will accelerate cost-saving initiatives. It continues to expect an additional $1 billion in free cash flow this year. That had been one of the points that was raised since last week, Anurag, that maybe IBM could be doing more when it comes to cost cutting. The plans that they've laid out so far, do you think that they go far enough?
See, that's been the case with IBM for several years. And one of the ways they do that is you right-size the organization, especially on the consulting side, where the bigger manpower is, and you move a lot of that work offshore. Because when you look at low-cost regions, companies or the clients right now are looking more for cost-cutting initiatives or cost savings initiative. And one way to do that is to do it from low-cost countries. And IBM Consulting is a very big, you could say, segment within the entire consulting framework. And I think that's a little bit of what's happening over there as well.
Anurag Rana over at Bloomberg Intelligence, helping us break down these earnings out of IBM in real time. And just a reminder, tomorrow we will be catching up with the CEO of IBM, Arvind Krishna. That interview is scheduled for 11:30 a.m. New York time, right here on Bloomberg. Meanwhile, here in Studio 2, Rich Weiss of American Century Investments is still with us. And I do want to go to this idea of some of the cost cutting, because there's been a lot of talk now, particularly with some of these larger tech companies, that there is sort of this idea that fundamentals are starting to matter a little bit more to investors than maybe they would have. It's just not about the revenue growth. They're paying a lot closer attention to margins. And I am curious as to how much wiggle room some of these companies, particularly some of these large tech companies, have to really trim costs in a material way, particularly given it seemed like some of them I felt like they did this already a couple of years ago.
Yeah, but there's more room to do it now, especially with AI. Again, just thinking back to my own business, the investment management business, there's a lot of room for cost cutting there. And the same is going to be true of these big companies. They're going to be cannibalizing themselves pretty soon here.
Yeah, and it's interesting because, you often see that being rewarded in markets, whether it's, reducing headcount, going about cost cuts different ways. And I wonder if you think that that's the stage of the cycle that we're entering into, back to, where sort of out of just the fire hose of Capex spending, whether or not increasingly investors are going to be looking for that, not just in tech, but across industries.
No question. Yeah, and they have a name for it, a word for it, productivity. Right? It's basically bottom line, right? Increasing the bottom line, not just top line revenue and earnings. But it's going to be cost cutting. There's going to be a lot of migration here and job switching across industries.
Rich, always a pleasure to have you.
My pleasure.
Rich Weiss, of course, over at American Century Investments, as we continue our coverage of these big tech earnings that come after the bell, including Alphabet. The shares now in the green here as we await for that conference call. Second quarter cloud revenue surpassing Wall Street estimates in a big way. The street was basically looking for about 64% growth. Alphabet gave them about 82% growth. Dan Flax joins us right now, senior research analyst at Neuberger. Talk a little bit more about the sustainability of this growth. And more importantly, we talk about the revenue growth there, Dan, but we'd be remiss in not pointing out that the operating income growth was also pretty phenomenal.
Yeah, that's exactly right, Romain. Great to be with you as always. What we're seeing is really this transformation of the digital infrastructure led by AI, and Google really has all of the key assets from the silicon to the models, the application, all the solutions in the cloud. And so in many ways, even with the very strong growth we've just seen in Q2, I think it remains very early. I think the AI labs, I think enterprises, really organizations globally are transforming themselves, and Google really offers a lot of the solutions that are going to help them on this journey. And so I think the cloud business remains well positioned, and I think we've obviously seen them doing more with their TPUs, their silicon, and so I think that opportunity remains in the early innings as well.
Well, we still are waiting to get a little bit more clarity about the Capex guidance. I mean, they've guided already to $180 to $190 billion for 2026, based on their previous comments about 50% growth from that. You do the math, that gets you to about $260 billion in 2027. Now that you've seen the growth with regards to the cloud business, would you be comfortable with them raising their Capex guidance even further?
I think Capex for this year will move higher, and I think Capex for next year will likely be over $300 billion. And so I would expect, given the performance in cloud, given really this broad set of drivers across search, across YouTube, what they're doing in terms of infusing artificial intelligence into all their solutions, that requires the investment. And the key for us is really that they're seeing the returns here. And so as long as they're able to drive this strong growth and the returns are visible and continuing to improve, I think the market will be comfortable with that. But to be clear, the Capex and the level of spend will, I think, remain debated in the weeks and months ahead.
Big time, and you can see sort of being debated real time in shares right now, treading water, traders deciding what to do after hours right here. When it comes to cloud, the growth that they're seeing, that they continue to deliver, there is the worry out there that you think about the shortage of computing power that we're seeing across the industry, really, that could sort of start to impact their ability to meet that customer demand that they've shown that they have. And Dan, I wonder how much stock you put into that sort of narrative.
I think the constraints are real. I would imagine that over the next several quarters, the industry will, of course, continue to add capacity. But even as we look into next year, I think there will be real constraints that impact the growth for Google, as well as some of the other clouds, Microsoft Azure, Amazon Web Services, among others. What's important here, though, is you're seeing Google invest in their own silicon and their TPUs. They remain a very large and growing customer of NVIDIA. And so this diversity of silicon, this innovation on the system and the silicon level, in my view, has been a hallmark of this company for several years. And I think it's going to help them as we look out over the next couple of years. But these constraints are going to remain a real factor. The key for the company is to be able to invest for the long term while continuing to navigate some of these challenges across the supply chain from one quarter to the next.
And to your point, Dan, I mean, you think about the news that we started the week with when it comes to Alphabet, that they're developing a server chip really designed to optimize Gemini. It's called Frozen V2, set to be deployed potentially as soon as 2028. It sounds like what you're saying when it comes to sort of Alphabet building out its own in-house capabilities, that's something that you expect to continue.
Yes, I think what's important is that given their size and given their workloads, they're able to optimize the silicon for their own environments. And so they're always going to be trade-offs around performance and power. But what Google's been able to do with their TPUs, for example, on this 8th generation, and of course, there'll be many more generations as we look out, and you mentioned Frozen, it's really this ability to optimize. If they know the models and the architectures that they're using, they're able to design the silicon to perform best with those architectures. And so this is a journey. I suspect we'll be talking about this for several years to come. And when I think about Google, it's going to be a mixture of using their in-house silicon as well as those of partners. And so the key is bringing all of this together and translating that into strong and durable revenue growth.
I'm curious about the balance between some of these new opportunities and, of course, the legacy business at Alphabet with regards to basically the ad and search business. And there's been a lot of hay made over the idea that we don't do the traditional Google searches like we used to. Is there enough of a bridge between that legacy business and what they're building for the future to keep investors like yourself happy?
I think there is plenty. I actually view search as very much a vibrant growth business. And I say that because the dynamics around search are changing. One is able to put longer, more complex queries in. And so as a user, there's a lot more value being created on one side. And then as an advertiser, there's more signal being generated. And those are very high return ads that those advertisers are able to place. And so in many respects, in my view, this is, you're seeing a resurgence in search, and this continues this company's history of reinventing itself. Now, to be clear, the competition in search is, of course, fierce. And so what we're watching is Google's ability to keep transforming the experience and adding value.
All right, Dan, got to leave it there. Great to get some time with you. That is Dan Flax. He's a senior research analyst over at Neuberger, breaking down those Alphabet earnings. Sort of a mixed bag because you saw cloud sales beat, but when it comes to search, which is all important, a slight miss there.
Yeah, a slight miss there, but it gets to this idea of where everybody is looking. And I mean, at least if you believe Dan, but quite frankly, even what we heard from our other guests, this idea here that they are building for the future and they actually have managed to get some traction.
Well, shares pretty much unchanged right now. We're going to check in on shares of Tesla coming up next, down about 3% after missing on a profit. This is The Close on Bloomberg. Tesla shares lower after hours after those results coming in as investors continue to scrutinize how companies are investing in AI. Joining us now to discuss is John McNeill. He is CEO of DVX Ventures, also former president of Tesla. So, John, you think about what we heard from Tesla, adjusted EPS coming in at 33 cents. That is well below the analyst expectation of about 51 cents on average. It's not often that you see a miss of that magnitude for a company as mature and as large as Tesla. So back this out for me and sort of make the math work.
Katie, I think it's compounded in that they beat the top line revenue by close to $3 billion. So you have a massive top line beat, and then you have this bottom line huge miss. And in the car business, that's pretty straightforward math. They are falling to the temptation of feeding the top line, which is a beast, to continue to keep growing with discounts. And when you discount in the form of price and in the form of the APR that people are paying, and they've done both, you see what happens to margins. They can have a huge top line beat because, of course, people are going to buy a less expensive product or a below market price product. But then the profitability falls dramatically. And in this case, they missed EPS by more than a third. And I think that's the story here. This is not an AI investment story. This is a story in the base business. And the base business, I think, is giving hints that the product lineup is older, it's dated. And in order to move that product, you've got to discount it. Right. And that hits the bottom line. And that's exactly, I think, what we're seeing here in these earnings.
Yeah, absolutely. A big tension there. And you think about the issues that they are having when it comes to their base business, the car business. How much of a setback is that for some of the ambitions that we know that the stock has been valued on? When you think about AI, autonomous vehicles, robotics, the list goes on.
Well, I think the original plan was you've got a cash flowing auto business that's going to fund you to the future of autonomous cars, robotaxis, and robots. But you got to have that cash flow, and that cash flow has to be healthy. And to the extent that your base business isn't funding the future, now you've got to go out and either fund it through equity or debt on top of this. And so I think that's the question for investors, is to look forward and to really try to determine how much capital it's going to take to get to that future, and then where that capital is going to come from. I think we see this across industries. It's one of the reasons we formed Vista Shares, is because the market tends to focus on end producers like Tesla, and the money is actually made in the supply chain. The supply chain has double the profit margins that Tesla has in the end. And so although Tesla's getting squeezed by the end market, their supply chain is likely much healthier, and that's probably where investors want exposure versus betting on Tesla as an end producer here.
But I mean, but don't they kind of go hand in hand, John? And I mean, you raised an issue here about kind of the staleness, my words, not yours, of their product lineup. And from at least what we know, it doesn't appear to be anything major on the horizon, unless Elon Musk is holding back on us. We're also supposed to see the Robotaxi rollout mid-year. I don't see any real mention of that in the earnings statement itself. So what is that sort of flywheel from the actual production of cars to these other ancillary areas?
Romain, you're right, and I think you nailed it. What they would say, I think, and probably what they're going to be talking about in the earnings call, is trying to get the investors to focus on Robotaxi as that flywheel. Robotaxi is the next car product. Robotaxi is the bridge into the robotic future that they see. The challenge is, as you said, they haven't had much luck rolling out Robotaxi. It's very small numbers, much smaller than they've originally projected. Much fewer vehicles, much fewer cities, and lower capability. And so I think it would be helpful if they could provide an honest assessment of where they are, where they see the rollout, because the car business really depends on the robotaxi business to get Tesla into the robot business, which is their Optimus robots.
Well, let's talk a little bit more about it. And they do actually mention that here, but I think at least based on what we know publicly, that still seems a long way off. And we talk about some of your ETFs, so obviously a focus on robotics, but also space. And I do want to kind of get to the elephant in the room, which is that a lot of investors seem to be speculating and even betting on this idea that Tesla will be folded into SpaceX in some way or another, what the time frame for that would actually be if it were to happen. But if it was, just to talk hypotheticals here, John, is Tesla additive to SpaceX, or does it actually detract from what SpaceX is trying to do?
I think it's
highly complementary. If I'm sitting in Elon's chair making that decision, I'm thinking about a couple of things. Number one, as you know, he's a fan of simplification. So running one public company is easier than running two, for sure. The second is the AI assets that are now sitting within SpaceX really are much closer aligned to the Tesla business. Robotaxis is an AI business. Robots are actually an AI business. And so those assets should be closer to each other. I think the third problem this solves on Elon's list is control. He's always been concerned about control share at Tesla. He doesn't have it. He does at SpaceX. And a combination of the current valuations of SpaceX and Tesla would mean that he would now have the control he sought for so long at Tesla. So I think if you put yourself in his shoes and the problems that are front and center for him, this makes a lot of sense, both from simplification, from the cap table in control, and from the proximity of the assets. Just having teams not have to cross companies to work on things like Robotaxi.
So, John, before we let you go, and this broadens it out beyond Tesla, but when we got that last earnings report out of NVIDIA, Jensen Huang talked a lot about kind of this physical AI, sort of the next stage of this AI cycle. And there was a big focus on robotics. And obviously, Elon Musk and Tesla are trying to be a part of that as well. But when I look at your ETF, your R2 ETF, which is focused on robotics, I'm struck by one thing. And it's something that someone raised when Jensen Huang talked about this, how so many of the robotics companies, at least the ones that seem to be poised to really take advantage of this, aren't based in the U.S. And some of your largest weightings in there are companies based in Asia. In fact, I was going down the list, you can correct me if I'm wrong, but the first U.S. company, at least in terms of your weighting, was Rockwell Automation. Why are we seeing so many non-U.S. companies sort of at the top of the list? Why are they ahead of the United States in that race?
Gosh, Romain, it's a really good insight on your part and a good question. That is because China is the largest supplier of robots in the world, the largest deployer of robots in the world, and not far behind them is Korea. So you've got a corner of the world that is really focused on robotics and executing at a very high level and executing at volumes far greater than the US. So as we went and combed the world for the supply chain in which stocks we wanted to have in that ETF, you're absolutely right. It turns out to be a lot of Asian exposure and some European exposure as well, but mainly Asian exposure because the end producers are there and therefore the supply chain is there. And that's really where the action in robotics has been for the last 5 to 10 years. And it's been quiet. Like, we haven't paid a lot of attention to this in the West. We're starting to pay attention to it now, of course. But those two areas in terms of China and Korea, they're the countries to beat as it comes to a robotics war and a robotics race to the finish line.
All right, John, always appreciate you taking time for us. John McNeill there, CEO over at DVX Ventures, of course, talking about his Vista Shares ETF, and, of course, a former president, I should say, over at Tesla. Katie?
Let's take a look at some of the notable movers after hours, because what a heavy earnings slate we have gotten. Alphabet now falling a little bit. We know that they beat when it comes to cloud revenue. They had strong Gemini usage, but maybe their search business disappointing or coming in a little bit soft. IBM cutting full year guidance as expected. Shares a little bit higher right now. ServiceNow shaking off some of the fear that worked through the stock when we saw IBM pre-announce last week, higher by about 4.4%. And Texas Instruments actually falling right now, even though it had a pretty upbeat forecast. It also said on the call that data center revenue doubled in the quarter, but shares down about 3.5%. This is The Close on Bloomberg.
Alphabet's conference call is now underway. The shares oscillating between gains and losses. Sundar Pichai now talking about Gemini and how it's driving growth for the company. Also saying that the search business still holding up. The fact that they had a great sort of a run during the World Cup. But a lot of focus right now about the company's Capex spend and how that translates long term into tangible returns for this company. Joining us right now is Matt Stucky, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management, which does hold a position in mentioned Alphabet. And I do want to point out one number that kind of caught everyone's attention, and that's the idea that Alphabet, probably one of the greatest cash generators that we've seen in the modern era, posting negative free cash flow for the quarter, most likely temporary to be sure. But I am curious, Matt, as to how comfortable you are with the company's spending and the return that they've posted on some of that spend so far.
Oh, good afternoon, Romaine. Look, I mean, I think in terms of the comfort, I think the comfort you look at is the margin structure that they're getting for that spend. Look, Google's incredibly profitable. They can afford in a certain quarter or a certain year to be free cash flow negative. But the incremental operating margins that they're getting on cloud are 2.5 times the average S&P 500. So you look at the S&P 500 today, operating margins around 20% or so. Incremental margins on cloud are in the mid-50s. And so if you're a management at Google, it does make a lot of sense to invest aggressively in this space, given the growth rates and the margin structure that we see today.
When we talk about how long this goes, is there a sense that there is a timetable that investors are giving to not just Alphabet, but all of these hyperscalers with regards to some of this spend? I know Google has shown already proof of concept. We've seen the numbers out of Google Cloud, 82% growth this quarter off of 63% the previous quarter year over year. The operating margins are there. That growth is there as well. Is there a timetable that you look at where you think, okay, how do we sort of ratchet down the spending and keep the growth actually going?
Well, it's just a question of how much demand is out there. And for the last 2.5 years, the constant message we've heard from hyperscalers is that they are compute constrained. And this past quarter is another proof point that that condition continues to be reality. Backlog jumped in the cloud business by another $52 billion quarter over quarter. And one data point that kind of sticks with me is that just 0.5% of the world is using agentic artificial intelligence today. If that penetration rate continues to increase, you can continue to see probably an additional demand for compute. And that's what companies like Google are uniquely in the position to provide to the global demand structure.
In addition to the Capex story, when it comes to Alphabet, when it comes to Google, I mean, you also think about sort of the equity raise that they put through last month, equity raise that they ended up upsizing to about $85 billion. And at the time, that was seen as, the markets being sort of unperturbed by their big Capex spending plans here. But then you take a look at what the stock has done since the beginning of June when we first got that news, and it's been drifting lower. And I wonder, as an investor, how you're putting together those different cross currents and the fact that they are out there and they are selling shares.
Well, I think they're being thoughtful about it, thoughtful in terms of kind of where the stock is and its valuation. It's trading 16x enterprise value to EBITDA. That's just well above its longer term average. And if they can take that capital and then invest it in Capex and translate it into, that continued strong margin structure in the cloud business and continued growth in search, is that an accretive growth type of proposition for shareholders? I think the answer is yes. And so, time horizon is your friend as an investor. Certainly, quarter to quarter, as you mentioned, the stock can move around based on sentiment. But, I think it's critical for Google to continue to remain at the leading edge in terms of their capabilities on the frontier level. And that requires investment. And that's probably what we're going to continue to see for some time.
Certainly, and we're seeing that investment. We're seeing them raise shares, also raising debt as well. And, Matt, one of the big reasons why we're paying so much attention to Alphabet is because it's ginormous, but also because it's, the first of its cohort to come out and report earnings. And I wonder, taking a look at the numbers, taking a look at the reaction that we're seeing in market, in your view, what sort of tone this sets for the rest of its Mag 7 peers?
I think you got to be careful in applying this to the rest of the hyperscaler space, specifically the cloud results. You could probably take the takeaway that, demand is going to be there, but at the same time, there might be idiosyncratic capacity that comes along depending on the hyperscaler. And so, take Azure as an example with Microsoft, depending on how much capacity they bring on, they might print some pretty strong numbers, or they might redirect some of that capacity towards first-party products. You just don't know. We're going to have to wait and see. But certainly, the takeaway for me is that demand continues to be pretty robust.
All right, Matt, great place to leave it. Can't extrapolate too broadly here. That is Matt Stucky. He is Chief Portfolio Manager of Equities over at Northwestern Mutual Wealth Management. Now, coming up, we're sticking with earnings. We're going to keep the conversation going with Ray Wang. He is CEO of Constellation Research. He joins us next with more on Alphabet's results and the AI spending wave. This is The Close. Alphabet's AI spending and the potential payoff. It's a major watch list item leading up to this earnings report. And we're also, of course, keeping an eye on Texas Instruments, ServiceNow, IBM, and Tesla on a very busy afternoon. Let's dig in deeper with Ray Wang. He is the CEO of Constellation Research and co-founder of AI Forum. So Ray, a lot to get to here. We've spent a lot of time talking about Alphabet, but would just quickly love your take because it's pretty much unchanged after hours right now. And when you think about sort of the cross currents of what we saw when it comes to their cloud business, the backlog there, the traction that they're seeing with Gemini, but then maybe a little bit of disappointment when it comes to the search business, how are you putting it all together?
At the end of the day, they have the free cash flow to support their new habit in AI. And what that means is they can spend the $190 billion. Street's not going to punish them for it. They know Google Gemini is ahead. They know the fact that this is being the #1 product enterprises are looking at. It's taking market share from other folks. And so they're investing for the future. If the Google Cloud numbers continue at 80-90% growth year over year, they might actually have a shot to catch up to Azure. If you compare head to head Google and Microsoft, Microsoft is behind in the investments, Microsoft's behind in the capital, and they're behind on the AI. So it's going to create a unique situation in the marketplace. But AI is winner takes all, and Google's playing for keeps.
Yeah, well, that's sort of what I was wondering. I mean, you think about the competitive cloud landscape right now and trying to make sense of it. Where does Google come out right now when you think about the fierce competitors that it has in Azure, when it has in AWS?
Well, when we look at that overall market, we think about what are people building on, what are developers betting on. When it comes to AI, they go to Google first. When it comes to developers, they go to AWS. When it comes to corporate enterprise, they go to Microsoft. And when they're really stretched for the edge, they're going to the neoclouds. So they're looking at CoreWeave. They're looking at Oracle as well to be able to handle those workloads. And at the end of the day, there's still not enough compute. What Meta's doing to open up compute, it makes a lot of sense given where we are in terms of the market. Permitting is not happening for a lot of data centers. A lot of folks are falling behind. Just came out of the AMD AI conference, and I was talking about all these different ways to actually create alternative compute while people are waiting for chips from NVIDIA.
Well, I'm glad you brought up Meta. I know we don't get their earnings until next week, Ray, but you actually think that this push that they're making is prudent, relative to the amount of money they have to put into it to actually make an impact?
I definitely do. And I look at cloud compute today almost like tenancy and real estate. Basically, what we have is people are building to supply. They're building built to suit. And what Meta is doing is offering capacity for people to lease capacity while they can. And while Meta doesn't need it at the moment, they're going to build up the capacity they need to get the AGI. And that's really where we see this. It's like a real estate play. Sometimes I feel like we're in a 2008 bubble. Something's going to crash. But so long the acceleration in growth and the acceleration in revenues there, no one's going to complain for a little bit.
I do want to kind of just push ahead. I mean, we did get earnings a little bit earlier out of Texas Instruments, the analog chip maker, which has found some relevancy in this AI race. We're going to hear from Intel, though. And there were so many high expectations baked into this stock over the last few months. And I know they've kind of waned just a little bit here. But where do they fit in to all of this? We talk about NVIDIA. We talk about AMD and obviously all the companies overseas like ASML and Taiwan Semi. Where does Intel fit in?
Well, Intel basically got a long lease on life when the president decided to look at chips as a national security issue. Almost every U.S. tech vendor made an order towards Intel, gave them a lease on life, but they've got to execute. If they can't get their chips up down to 3 nanometers, 2 nanometers in a way that people can use, if they can't get the fab business up on time, there's going to be some issues. Right now, they've been buying some time. They've got 12 to 24 months to show that they can execute. Revenues are better. Lip-Bu's got the culture going. It's definitely a difference compared to what we've seen from the last 5 years, 10 years. It's a big difference.
Ray, always a pleasure. Ray Wang, CEO over at Constellation Research, of course, the co-founder of the AI Forum as well, as we keep an eye on the shares of all of these companies oscillating between gains and losses. Alphabet conference call is underway right now. Texas Instruments conference call underway as well. But at the top of the hour, we are expecting to hear from IBM, expected to also hear from ServiceNow, and in about half an hour's time, we're expected to hear from Tesla. Bloomberg tech host Ed Ludlow joins us right now to talk a little bit more about this. And Ed, I do want to start off first with kind of what we should expect to hear out of IBM and ServiceNow, because there's been so much talk about how software firms, consulting firms are sort of having sort of this huge challenge as all of the AI attention goes to the hyperscalers, goes to the chip makers.
Yeah, on the ServiceNow thing, remember the application layer. And so you have to decide, are you counting them in the software bucket or not? There is a lot of commentary that supports the idea they're getting spend. They have relevance for people that are deploying agents in real enterprises. Whether the numbers show that or not, that's the case that the management will make. And you and I are so laser focused on IBM right now. What did we learn different today from the prelim results? That it's not just the mainframe business. The software business is getting hit. That's why the cut in the outlook factors that in, and they couldn't have been more explicitly about that legacy software business.
And Ed, we only have about 45 seconds left with you, but talk to us a little bit about Tesla, because taking a look at their numbers, it looks like that big EPS miss that they saw, maybe sacrificing profitability for the top line.
Yeah, there's a big difference between operating cash flow and where you're spending the money and what accounts for negative free cash flow. Wall Street wanted them to spend big on Capex, and they just haven't. They're not tracking to even meet the existing $25 billion guide. So tangible evidence that they're making progress on Robotaxi and Optimus, but they're willing to spend aggressively to get there. There was nothing in the deck at all about that. And there's very little to go on about where they're at in those future business lines.
Just real quickly, Alphabet, Ed, were you actually surprised by what we learned today?
Didn't learn much. I mean, everyone is waiting for them to raise the Capex number. I heard what Ray said. If they take Capex 200, 300 billion, what happens to their cash flow? That's what people care about.
That conference call underway right now. The Google CFO now saying that quarterly Capex primarily funded AI infrastructure. More clarity on those numbers should come up, and we will have that breaking for you here on Bloomberg. And don't forget, tomorrow, we're going to catch up with the CEO of IBM, Arvind Krishna, at 11:30 a.m. Eastern Time.